Mr. Chairman, thank you for holding the hearing. I look at this issue and I think about what is the market. The market is a series of investors seeking to invest in companies that hopefully will provide them a yield, a return on their investment so that they can personally prosper. And the flip side of that is a series of companies looking for investors so that they can grow their companies and prosper as well. And so there are two essential ingredients here. And one of them, but for their investments, would really not make the market what it is. Without them, there is no market. And so investor protection seems to me to be incredibly important. And I know that some say that the CalPERS of the world and the unions of the world are special interests. They happen to be the biggest singular investors along the way in this marketplace. So I don't look at them as a special interest. I look at them as a significant part of the marketplace, representing a broad universe of individuals at the end of the day who are taking their savings and making investments for them. And so ultimately, it seems to me that investor protection in their respect as well is a very broad one because they represent a very large universe of people. And at the end of the day, more than ideological issues, I think they want to see their investments grow on behalf of the people who they invest in. So I have a little different view, but I have two sets of questions that I want to pursue. One is, Mr. Roper, with you. Soon after Dodd-Frank was signed into law, the SEC put out a study recommending a consistent best interest of the customer or fiduciary duty standard for broker-dealers and investment advisors, a priority that both Senator Akaka and I successfully fought for in the Wall Street reform with our Honest Broker Amendment. And I know that the Certified Financial Planner Board of Standards recently sent a petition to the SEC with more than 5,000 signatures of financial planning professionals who favor fiduciary duties for all financial professionals giving investment advice. Do you agree with having a high and consistent standard of the best interest of the customer for all stockbrokers and financial professionals? And if so, why?
Absolutely, I agree. And any of you who were the recipients of my nearly daily letters on this subject during the legislative battle maybe remember that. This is in many ways the most important issue for retail investors. The last investment decision most people will make is who to rely on for recommendations. And the situation in the marketplace is this. Mr. Atkins says, broker-dealers and investment advisors are doing two different things, so they should be subject to two standards. But let's review that. They call themselves by titles that are indistinguishable to the average investor. They both offer extensive personalized investment advice, and they both market their services primarily based on that advice. If they are doing two separately, distinctly different things, why has the SEC allowed them to present themselves in a way that makes it impossible for the average investor to distinguish between them? So if the investor can't distinguish between them, and we know from survey research and focus group research that they can't. In fact, the RAND study found that investors could not tell whether their personal advisor was a broker or an investment advisor, even after the differences had been explained to them. So they cannot go into the marketplace and make an informed decision based on an understanding of what services are being offered or what the standard of conduct is for those services. So the reform that is needed is to ensure that when they're doing the same thing, when they're providing personalized investment advice to retail investors, they should be subject to the same standards. Now, the brilliance of the proposal that the SEC has put out there is that it recognizes both the need to raise the standard and the need to preserve investor access to a transaction-based source of advice. Not every investor wants ongoing account management. Not every investor wants, comprehensive financial planning. So investors benefit if there is a source of advice available that's compensated through commissions that offers advice on a transaction basis. And the SEC uses the authority that Dodd-Frank gave it to put out a proposal that recognizes this. Brokers can still charge commissions. Brokers can still sell proprietary products. They can sell from a limited menu of products. and the SEC has said they will deal with the principal trading issue. They are making every effort to ensure that this advance in terms of the standard of conduct nonetheless retains investor choice.
And at the end of the day, they can make all of their commissions, but they have one standard, that be the best interests of the investor.
Absolutely.
Otherwise, you could very well lead them to investments that would not necessarily be in their best interest. But
Absolutely. Absolutely. There is a difference between what you can do to satisfy a suitability standard and what you would have to do to satisfy a fiduciary duty. Now, they start from the same basis. You have to know the customer. You have to do that analysis to determine what is appropriate for that investor. The fiduciary duty requires the broker to take an additional step and have a reasonable basis for believing that what they're recommending is not just appropriate for the investor, but in the best interest of the investor within the limited menu of options that they have available to sell. And where they have conflicts of interest, they are still able to operate, but they have to fully disclose those conflicts of interest to the investor. So they can no longer make recommendations based on their own financial interest because they get higher commission without disclosing that conflict to the investor and without then ensuring that that recommendation is also in the best interest of the investor and not just their own bottom line.
I have one other question. I want to turn to Mr. Turner. Mr. Turner, one of the provisions that I successfully included in Dodd-Frank would require publicly listed companies to disclose in their SEC filings the amount of CEO pay, the typical workers' pay at that company, and the ratio of the two. Now, over the last few decades, CEO pay has skyrocketed while the median family income has actually gone down. There are those in the House that have opposed this because they say it's too burdensome for companies to disclose that, and second, that the information isn't useful to investors. I find it hard to believe that companies that do all kinds of complicated calculations for everything else involving their revenues and expenses would find it difficult to take their 2,000 employees, figure out how much employee number 1,000 is paid, and report that one number to the SEC. It seems to me that it's much more about hiding the fact that many times CEOs have 400 times the pay of their typical employee. Do you think it would be burdensome for companies to figure out how much their median worker is paid and report that number?
Senator, as you know, I was an executive in a semiconductor company that was international. We were one of the larger importer-exporters at the time, in fact, in the country. And I don't think, in fact, I'd be surprised if for most companies that was a difficult thing. First of all, it's something you ought to be managing, so you only manage what you measure in the first place. And if the compensation committee of a board, and I've sat on some of these boards, wasn't even looking at that ratio, I'd probably be concerned. It'd tell me there's a lack of management here, a degree of management that should exist, but in terms of just getting the raw data, no, I think there's ways you can go about it. The SEC can implement some rules. I think they've been encouraged to implement some rules that are reasonable, that wouldn't have a great deal of cost. And again, let's keep in mind when we talk about cost, this cost global markets $28 trillion. It cost U.S. investors 10 to 11 trillion. Much of that was due to very, very poor incentive packages. And in light of the fact that executive compensation last year was up 23%, while Main Street wages went up zero, I think it's fair to turn around and start managing and taking a look at that issue, and I think compensation committees should. I think they can. I think CFOs in the same role I was in can get that number, and no, I don't expect that to be a high-cost number. If it's a high-cost number, that company probably has some other management problems as well.
Thank you. Thank you, Mr. Chairman.